Okay, will the 2013 stock market close up? It looks like it will. The stock market normally does what it did in the previous year. And in the stock market in 2012, the stock market closed up. And we're going to see this a little. The reason for that was the short sales dried up. Pretty much the first quarter of the year when Fannie Mae and Freddie Mac ran out of foreclosures in 2012. So the housing strengthened a little. There were 367,000 new homes that were built and sold compared to 306,000 in 2011. So building did improve slightly. Home prices, depending on what survey you look at, improved between 7 and 14%. I've seen 7, I've seen 10, I've seen 14%. Um, and also, of course, banks they spent a little less on foreclosures, and some banks ran out of foreclosures. So housing prices went up. January closed up, and it's very interesting that after Christmas, after the lack of Christmas sales, usually January, they call it the January barometer. If January is strong, that shows that there's strong manufacturing and services, and that actually was the case. Factory orders are very strong. They're about the strongest in 8-9 months right now in March 2013. Home prices are up due to the short sales drying up. Building materials also are a little stronger, like cement and nails, lumber, roofing. And also we see that the loans, the Alt-A option arms loans almost completely ran out of resets in October of 2012. That will give another boost to housing in 2013, and these other sectors will continue to do well in 2013. The shadow inventory is dropping. We'll see a graph of that. And we have a smaller number of homes for sale. So let's look at some of these things here. We see that the NASDAQ closed up. And notice how these 10 years here, these 10 years of the NASDAQ and the Dow and the S&P 500, notice how they all recovered after the dot-com bubble. They all fell with the subprime loan crisis, and they all rallied, and they all had these two little dips here where you had the first wave of the Alt-A and option arm loans resets that affected gains for home builders, building materials, and also banks and insurance companies. And the same thing here, the second wave, also there was a dip here. And essentially the stock market just does what it did the previous year. That's why where you have here the where you have the NASDAQ and the Dow, breaking out to a higher high here, and the S&P 500, they're going to continue to do well in 2013 because essentially the market just simply does what it did the year before. And I like to watch the monthly MACD formula because it's positive and it actually gives very few sell signals. In the Dow, it gave a sell signal January 31st of 2000. Before the dot-com bubble. Then it gave a buy signal in March of 2003. And then it gave a sell signal at the end of 2007, a buy signal in just before the middle of 2009, and then it had a little whipsaw in here where it gave a sell and a buy signal with this second wave of Alt-A and option arms loans. But if you'd been following the Credit Suisse report, you would have known about that the market was going to be in for really tough times there in 10 and 11. And it's positive, so the market will probably continue on that trend. And we'll look here at another graph. We'll see here, actually this here shows here that services industries in the U.S. grow at the fastest pace in a year. That's the same thing with manufacturing. Manufacturing is picking up in 2013. So these are actually very positive things about the economy in 2013. We see here that the Case-Shiller Home Price Index, we see that it fell with the subprime loan crisis and went up in 2009 when the subprimes quit adjusting and the government lowered rates. But then there was a couple dips here with the two waves of Alt-A and option arms loans. And now in 2000, here you have the 2012, the home prices are now finally going up. They're actually showing strength of going up. Short sales have almost completely gone away, and foreclosure sales are slowly going down. Here's here's a 10-year graph of Chase, and we see this 6-year downtrend line was broken in January of 2013. And this 6-year downtrend line corresponds with 6 years of loan resets, the subprime loans, and the Alt-A and option arms loans. And so now, since that dried up, it almost completely went away October of 2012. The banks and builders, home builders like KB Homes, banks like Bank of America, Chase should do very, very well. Here's the shadow inventory of these are bank-owned properties here, the dark blue. These are the ones that are in foreclosure, and these are the ones that are seriously delinquent but are not in foreclosure. And we're down under here. When we look at it, we're down to about 2.2 million. Okay, and so this is falling. It's been going down. And since the Alt-A and option arms loans quit adjusting in 2012, there's going to be less people suddenly in 2013. I expect this to actually go down over the next 3 years. I expect this to have a steeper decline here over the next 3 years to go down to 0. And that will happen because less people are less having their loans reset. Less homeowners are having their loans reset to higher payments, and so less people will default. It is tragic that I estimate that about 7 million people lost their homes in this. I think that the whole thing is very tragic. And here's another graph showing that the inventory of homes for sale back at the end of 2009 were between 12 and 14 months supply. Now it's down to 4 months supply. A perfectly normal number. When you look at history going back to the 1960s, we see that this is just a perfectly normal number. That's why home prices are strengthening in 2012 and 2013. And so these are the reasons why the stock market should rally in 2013. Essentially, it does what it did the previous year, and we see that building materials, home builders, banks, insurance companies, the service sector, and manufacturing are all picking up in 2012 and 2013, and the stock market should continue in the same direction it went in the previous year, unless something knocks it out of whack, something like a war scare or higher interest rates, and it doesn't look like we're going to have higher interest rates soon. So I can expect this trend to actually continue 2013, 14, 15. I expect the stock market to do very, very well. Have a nice day. Bye-bye.